Why is normal distribution a flawed assumption for efficient frontier? Imagine trying to predict how a roller coaster will behave based only on how it usually moves. It might seem logical, but real-life rides can surprise you with sudden drops or sharp turns. That's similar to what happens with asset returns in investing. The efficient frontier uses a method called mean variance optimization, which assumes that returns follow a normal distribution. But in reality, this assumption doesn't always hold true. The normal distribution looks like a perfect bell-shaped curve. It assumes that most returns are close to the average, with extreme gains or losses being very rare. It suggests that losses and gains are equally likely and that big surprises are unlikely. But actual financial returns often don't behave this way. They tend to have skewness, meaning they lean more to one side, and kurtosis, which means they have fatter tails. This means big losses happen more often than the normal distribution predicts. Because of this, risk estimates based on normal distribution can be too optimistic. They underestimate the chance of extreme events, especially tail risks. Tail risk is the possibility of very large losses that can seriously harm a portfolio. When investors relying on these flawed risk estimates, they might think they are safer than they really are. This can lead to taking on more risk than intended or being unprepared for market crashes. Another issue is how the normal distribution affects correlation calculations. Correlation measures how assets move together. During market stress, assets tend to move more in sync, a phenomenon called correlation breakdown. Models assuming normality don't capture this increase in correlation during downturns. As a result, diversification benefits might look better on paper than they actually are in tough times. For adults building investment plans, sticking only to the efficient frontier can be risky. It might suggest portfolios that seem balanced but aren't resilient enough for extreme market moves. To address this, investors should consider models that include skewness and fat tails. Using risk measures like conditional value at risk can give a clearer picture of potential losses beyond what standard deviation shows. In essence, the normal distribution simplifies reality too much. It underestimates the true risks of investing and can mislead investors about the real trade-offs between risk and return. When planning investments, it's wise to look beyond these assumptions and incorporate tools that better reflected how markets actually behave.